especially if minimizing costs are going to be a big deal, are identified here in chapter 1. Page 4 is where we begin our discussion. And I'm going to move through this very, very fast so that you can find in your textbook the language necessary in your presentation to get at if in fact you've got a minimization going on. So it's under the section on page 4 titled cost measurement. And cost measurement, and some of these terms will become important. For example, the difference between direct costs and indirect costs. What's nice about this section here, the authors have helped you to identify direct costs and indirect costs by way of service organizations, the bottom of page 4, retail organizations, and on top of page 5, manufacturing organizations. So they've given you some great examples, good examples, of what you're likely to be able to find relative to direct costs and indirect costs. To help you understand direct costs very quickly, I don't know if any of you have ever gone into Safeway or a Safeway store in the produce department, and as you were reaching in to pull out one of the vegetables, all of a sudden you heard thunder and lightning and rain. Have you ever done that? I have too. Kind of freaked at the very first, and then I got what was going on. That water coming out would be a good example of an indirect cost. I suppose you could get at a direct cost by taking your cup, somebody at the store, and as it began to rain, collect the amount of water, counted the number of quarts, and come up with that. But we don't do that in the real world. We classify those kinds of things as indirect costs. And so your text does a fairly good job in giving you examples of that. If you look in the textbook under indirect costs, second sentences, some examples it says includes the nails used in furniture. It's not necessary, Joe, by the way, in your business, to classify as a direct cost the number of nails you're using. We refer to those as indirect costs, right? So nails to use, for example, in furniture, or the salt used in candy, or the rivets used in airplanes. All industries have both direct and indirect costs. If you're dealing with an issue that is minimizing at its objective function, you're going to have a cost analysis you're going to have to do. And your question will be, are we dealing with a direct cost or an indirect cost? Does that make sense? So at the very beginning level in understanding cost, we get at both direct and indirect, and your text does a fairly good job at delineating some of these with those 3 different kinds in organization. On page 6, bottom of page 6, again very quickly, we also have something the book titles as cost behavior. We have variable costs and we have fixed costs. Variable costs and fixed costs. So not only do we have direct and indirect, but we have variable costs and fixed costs, and some of the variable costs and fixed costs can be direct or indirect. For example, fixed costs can be your monthly rent. Why is that fixed? Because you know on a monthly basis what that rent's going to be. But then you can have variable costs that change in proportion to the amount of production you have, for example. And so costs that change relative to the amount of production would be termed as variable costs. So here are 4 terms that you will want to grapple with, somebody in your group, if you're looking at the objective function, and it includes minimizing something, which means you would largely be, if this were the case, focusing something smoking or on fire in the financial perspective. Right? Does that make sense? Some red flag that came up when you were doing your survey or analyzing financials, and a good discussion with one of your colleagues about analyzing financials, and someone's going to need to do that very quickly. And if something is smoking, something glaring is coming out in the operating expenses by way of peer comparison, way out of line, could be labor, could be materials, could be a lot of things, then it would make sense that the financial perspective is something you're looking at, and the language you're going to be using to talk about minimizing costs is found right here. Is it a direct, indirect cost? Is it a variable, or is it a fixed cost? Make sense? Easy terms for you to get your mind around when you're making your presentation and or you're writing what's going on here. And then finally, in this section here, just simple 3 pages I wanted to draw your attention to, is something called value-added versus non-value adding costs. Those are very good terms worth noting on page 7. You'll note that a value-adding cost is usually a variable cost. It's usually going to be going up. A value-adding cost is usually a variable cost. But it's the cost of an activity that increases the market value of a product or service. That's noteworthy. That's noteworthy. Therefore, if a value-added cost is something you're going to be looking at in the financial perspective, but it in fact has a contra effect by increasing market value, then it may answer the question, how do we get at better profit, or we get at more revenue? You see, it's a value add. It's a cost, in other words, that we incur that's going to bring greater value somewhere else, a value-added cost. A non-value added cost is quite the contrary. It's a cost you're adding on that's not going to bring added value. You see the text talks about that. It's an activity that adds cost to a product or service, but does not increase what? Its market value. It doesn't increase its profitability. It doesn't increase what it is in terms of an organizational benefit. So value-added, non-value-added cost. 6 terms: direct, indirect, right? What are the other 2? Direct, indirect, variable or fixed, or value-added cost or non-value-added cost. 6 good terms worth noting, attacking, thinking about, understanding, getting at, if in your objective function you happen to be a team that's working on something that needs to be minimized. My guess is the shop that's dealing with Chrome shop, hands for the Chrome shop. I'd have somebody in your group crunching the numbers, and my guess is, especially if you can get a peer comparison, you're going to have an issue in operating expenses. That's my guess.
I'm pretty sure of that already myself.
Yeah. It's that, or it's going to be revenue, but it's likely in the expenses. And if you can get a peer comparison that you can sit down with your friend and say, listen, this is what's going on in your industry on a per store basis, that's best practices. This is where you're at. Friend, do you happen to see where the problem might be? Right?
Hmm?
And then, of course, express it, explain it, display it, solve it in your presentation. Right?
Yep.
Somebody in your group has to get at right away, getting at the financials and doing a vertical analysis. Step number 1. Somebody, you got to delegate tonight before you leave. Who's going to take the financials? Remember I told you vertical analysis? That's step number 1. Who's ever the math person, don't give it to the non-math person. Give the non-math person writing skills. You are the math person. Yes, my dear, you are. You are. You're not even turning red. That means you agree with me. So,
there's no denying the truth.
that's exactly right. It is truth, and it is speak truth. Therefore, somebody do vertical analysis. All of your groups attack the vertical analysis right off the bat. And then someone else in your group concurrently find a peer comparison and do the vertical analysis and the peer comparison. And then take the peer statement and take your statement and come together and contrast and compare and see what is smoking. Do you see what I'm talking about there? It will illuminate some issues. And by the way, those issues might point to this, or that, in addition to that. You follow me on that?
Mhm.
Yes.
So the peer comparison, if you can't find other businesses, is just gonna be their own past, all their.
And one of you are going to be responsible for doing that. Okay? Right. Or question. So chapter 1, these 4 pages give you some example. Exhibit 4, listen up, Exhibit 4, page 7, is a fairly good exhibit that gives you examples of direct cost, indirect, variable, and fixed, value-add, and non-value-add for different kinds of cost examples. Worth looking at, noting at, if you are discovering that you are a minimization issue consultation group, and you want to get us some language consistent with your presentation and or your book. Okay, makes sense? So, chapter 1, a fairly easy read, a fairly easy construct to put language to cost. Your group may have one of your centers. I've already consulted with one of your members to begin defining your various hospitals as operating centers, operating centers, or cost centers. Either one of those are worth noting. Cost centers or operating centers. And you're going to immediately, as I shared, you're going to take the financials you had and develop the vertical analysis immediately between the cost centers. And you're going to ask the salient question, why is cost center A appearing to do so much better than B, C, and D? What's going on? And more importantly, if you can, A, B, and C, D are sitting here. And you've got something out here that's talking about best practices. And you may find out that best practices is not even doing as well as cost center A, and if that's true, you ask owners, would you like replicated in cost center A in B, C, and D? And if you do, what are you gonna do, how are you gonna do it, what's it gonna look like, and how are you gonna frame it in a balanced scorecard to get to that objective? Okay, so lots of ways we can do this. But cost is nicely articulated in chapter 1 right off the bat. Don't miss that. If you're a minimization, I think you're gonna find that maybe here. Most definitely, I'm fairly certain, I could be wrong, but most definitely in a retail environment that is nitty gritty, you know, sort of in the dirt as Chromie might be. Tends to be in a mom and pop operation, out of control operating expenses. Okay? Cost of goods sold may be an issue. You guys are gonna have to figure that out. All right? That's chapter 1. Easy homework this week. No sweat on that. I'm not gonna spend any time on what the homework looks like for chapter 1. Yes, that's a good point. So, operating centers. Operating centers for this particular case, or cost centers, happen to be businesses that have multiple locations. Businesses that have multiple locations that are doing something very similar, if not identical. We refer to those as operating centers or cost centers. We don't refer to them as location A, B, C, and D. You can at a sub-level, but you're really saying operating center at Churn Creek and Cypress, for example. Or a cost center at Churn Creek and Cypress. That's how you're framing the language here, by way of defining it.
So just for clarification for us, with regards to cost centers, I was under the impression that there was different departments, even one hospital per hospital, correct? Different centers per.
Yes, that's
so
right.
Multiple centers in one, multiple centers in another, different.
You can frame it that way,
departments
that's right.
Okay.
Yeah, that's right. Let me clarify that though before you leave, to make
Okay.
sure that we're on the
Thank you.
same package on that. Same place on that. All right, the next section that we're gonna wanna look at very, very quickly here is I don't know.
Perfect.
Yeah.
We're on the same page.
Yes, we are.
That was honesty.
Can't seem to find session 2 anywhere in my notes here, but don't worry, I will find it. Let's see, all the way over to chapter 5. Chapter 5 is what we want to move into real quickly. Chapter 5. Chapter 5, beginning on page 164, your textbook brings up more costs. But you should note that in chapter 1 and in chapter 5, somebody in your group should note that in chapter 1 and chapter 5, page 164 through 168, right in that neck of the woods, are good chapters to be framing language consistent with costs. On page 164, under cost behavior, in that section 1 in chapter 5, you see variable costs, once again articulated. But more importantly, and as good as chapter 1, exhibit 1, top of page 165 is excellent, excellent. Delineating between variable, fixed, and mixed costs for manufacturing, or a store or a service company, if you're dealing with that. So it's worth noting, it's worth putting a tab on or getting at if you're struggling with whether you want to identify a variable, fixed, or a mixed cost. A mixed cost is nothing more than a combination between a fixed cost and a variable cost, and I'll show you that in just a moment here. So exhibit 1 on page 165 is quite good. Over all the way over to page 167 is mixed costs. Mixed costs, I just alluded to that a few moments ago. And mixed costs have both variable costs and fixed costs. You see that right smack next to mixed costs. Mixed costs are both variable costs and fixed cost components. And it's an interesting phenomenon that goes on in business, but it's something worth noting that. All right, so those costs, those 5 times, those type of cost indicators in these 2 chapters will be, I think, important for those of you who might be looking at minimizing. Now, very quickly, on page 173, there are a couple things I want to point out, but I'm not going to have time tonight. I take it you'd rather be released in working groups than me teaching. Is that true tonight?
Yes.
Because I think the material here you can get.
No offense.
I think you're
None offense taken.
all the respect.
And I are going to have a discussion after class. Disrespect.
I said it all these.
I appreciate that. I'm learning.
Excellent teacher.
Excellent.
Just say what you want. Yes, it does.
Words
Doing
of
that,
affirmation.
very well.
Oh, goodness. She knows my words of affirmation in the faces. Stop it! I framed that completely wrong. I should have thought about that before it came. My Debbie always tells me, no, you need to really work on that. No, I don't. So reframing it, I take it you love to work in groups tonight, is that correct? Okay, so let me just point out. Oh, you're all busted. Okay, so, look, there's some really good things that I'm missing out on talking about. I'll bring it up a little bit next week, but there are a couple things I want to point out that are worth noting. A very good managerial accounting stuff. On page 173 is something called break-even point, or margin of safety. That's good stuff. I'll talk about that next week. Your homework assignment's going to include that on page 173. On page 171, another really good principle: contribution margin and income statement. Oh, yikes. Easy to get at, easy to understand, but good stuff. And worth a note, contribution margin on page 171. So those two things, the break-even point and the contribution margin income statement is something you're going to be looking at this week. All right, easy. Exhibit 7 on page 172 gives you a good example of the traditional income statement on the one side and the contribution margin income statement on the other. Listen to me. Here is your task. For those of you who are assigned vertical analysis in your organization, those of you who are assigned the numbers, your second task will be, in that assignment, is to build next to your income statement vertical analysis a contribution margin income statement. It's easy. You just study it. You'll see how to do it. Okay? Do it. So next week when I talk with you and I sit down with you on a group-by-group basis, I'm going to ask you, what does your contribution margin income statement look like, and I'm going to tell you why. Help you understand what this whole thing's about. Okay? You get that? Contribution margin income statement. So we have a traditional income statement on the left side, and we have what we call a contribution margin income statement on the right side, and you'll understand what the elements of it are on the right. All right? Get into this week. One other chapter, and then we'll be done tonight, and that's all the way over to chapter 7, that's correct, thank you. All the way over to chapter 7. Let's have a TA, I'll tell you. And that is, in this chapter, this is all the way over to page 256. 3 things I want to show you on page 256. And then I'll be done. I'll run a little bit further than I thought. I'd stop at 8:45. I'll stop at 8:55 and be done. Give me 5 minutes here and I'll be done. In this chapter on page 256, this gets us out of shifting away a little bit from costs, now to looking at tools, performance measures for the financial perspective. Tools, the performance measures we're going to use in case we're looking at maximizing something. And one of the tools that we look at that can be a performance measure that you see in this chapter is something we call ROI. It's return on investment, ROI. And the ROI calculation you see here is operating income divided by assets invested. Now, assets invested is the beginning asset value of the year and the ending asset value at the end of the year, and combine the two and average them. But ROI is a good indicator because you can see it's taking operating income in the numerator, dividing it by the assets. It's really telling you how well your assets are making you money. How much money is this making me? If the school isn't analyzing how much that seat is producing in income by each one of the students here, then they're not using ROI. If you've got printers and calculators, if you've got a machine that turns and forms metal, you would be very interested in knowing whether that asset is producing you money or not and what that ratio is. And if that ROI, listen up, is X and best practices is Y, the question is, if you want to move towards Y, what do you got to do to ROI to improve it? What's in the numerator? What is it? And what consists of operating income? What's above operating income? Operating expenses and revenue, isn't it? And what do you got to do in the denominator? What's in the denominator? Assets. And sometimes that means you got to minimize assets, sell some assets, or increase your assets. Okay? ROI is a good one. Worth looking at, worth noting this week. The other one worth looking at this week that you will look at in your homework, page 257, profit margin and asset turnover. And I already told you profit margin is operating income divided by revenue. I already told you that. Operating income divided by revenue, it's right there. Profit margin is defined for you. What is it? Why is it? Why is that important? All of you, every one of you, the numbers person. Task number 3. Task number 1 is vertical analysis. I told you that, yeah? Vertical analysis with your company, vertical analysis with peer company. What was step number 2? Contribution margin. Number 3, right here, number 3 is calculate what? Profit margin. Each of you should be able to tell me next week when I sit down with you, one of the first questions that's going to come out of my mouth is, what's the profit margin of this company? What's the profit margin of the operating centers? Okay? Very important question. And what would be very helpful is, how does that compare to peer comparison? To the peer. What's the profit margin at the peer comparison? If it's at X and you're at Y and X is better than Y, what's going on? What do we got to do to improve that? Asset turnover is another good one. You'll see that on page 257. On page 258, you're going to calculate residual income. And then the biggie for this course, and the biggie in general, is EVA, economic value added. That's a big learning outcome that the university in the state of California wants you to get at. And that's EVA on page 259. That's going to be part of your homework assignment. You can see EVA is after-tax operating income. Listen up, after-tax operating income. Remember I said operating income here, and then underneath operating income down here were 3 things. What are underneath operating income? Usually 3 things. Interest, taxes, and what? Depreciation, right? In this case, what are they saying here? What are they saying for EVA? They're saying after-tax operating income. What does that mean? You have operating income minus tax equals that. That make sense? All right, so far so good. And then and then you see minus the cost of capital, that will be given to you. That's a discount rate I taught you last semester in economics, times total assets minus current liabilities, that's EVA. That's your homework assignment. It's easy to do. You'll have no problems doing your homework assignment, but that's a very good indicator if you're smoking in the financial or you're on fire in the financial. Residual income and EVA are 2 good financial indicators, including ROI and asset turnover for you to be looking at. It's a good chapter, in other words, if you're maximizing something. So those are the things I want you to be looking at this week for your homework. Okay, does that make sense? With that said, now that I know you want to spend more time with each other than listening to me, let's do that. So I encourage you to take the next 45 minutes and